All right, being recorded. Excellent. Welcome everybody. I just wanted to let you know that I'm a commodity guy, a futures guy. So I won't be handling questions about stocks, etc. Of course, the stock indices are always something that we look at as far as analysis is concerned, and had a nice early trade in that this morning. I'll show you what that was. Kind of a quick trade. But I want to show you how I got there. But it's really up to you to let me know which charts you'd like to look at, and I will give you my humble opinion on it. I'm really a basic guy. You know, I honor things like support and resistance. As you can see, when I trade, I'm looking at several charts at the same time. You're seeing here the S&P. You're seeing the euro dollar. Up here on the left is the Japanese yen, the gold. This is actually Bitcoin, which I trade the micro or mini Bitcoin, whatever that is, MBT. It's kind of a 1/10 of a Bitcoin, one hundredth, like 1/50th of a Bitcoin contract, which is 5 Bitcoins, but whatever. It's something that is now tradable, and I hope somebody asks me about that. And here's the copper. And with all of these charts, I have, here's the gold, but I have the silver ready to go here and the bonds ready to go if I need it. My belief is that, listen, there's only two things that you do when you trade. You get in and you get out. And there's a lot of stuff that you can think about and handle to minimize your risk in between. I do a whole kind of lecture on that. But essentially, you're buying and selling, and the buying part, it can be is of course a very key part. If you can find a trigger or a couple of triggers, at least one trigger that you know will get off to a good start. In other words, move in your direction once applied. Very high. When I say a high probability, I mean at least 2/3 of the time or more. If you can identify that that kind of a trigger, then I think it's the most efficient thing to do is to look for that trigger and actually trade it as exclusively as you can. And since the triggers that the couple of few triggers that I use that qualify for being a reliable A+ trigger is may occur 3 or 4 times in a 5-minute chart, which I trade from 5-minute candle chart. It can occur maybe 3, 4, 5 times in a day. But I'm a guy that kind of likes the action. I like to be in the market when I can be. You can't make any money looking at it, but you can't be in irresponsibly either. So what I like to do is I like to isolate that 1 or 2 triggers and then look for that to happen in markets that are tradable. And when I say tradable, I mean have the volume and have the basically has the volume and has the history of being a market that does not screw you when you put in a stop order. Now, I kind of mentioned that because I think now the Bitcoin has fallen somewhat in that category, although the spread is very wide on the Bitcoin contract. If you use limits, you can use very small contracts, so it's kind of okay to be get a fill. It's not perfect. It doesn't hurt you too much, and of course, as you know, Bitcoin can really move. So anyway, that's for a later discussion. So I'm going to take a look at some charts based on what I believe are fundamental analysis, and you can see how simple my charts are. I don't have a lot of stuff on them because I find that the basic stuff works fabulously. So why do anything else? Let's look at the chat and see. Now, is SMCI, is that a stock? I got a feeling it's a stock because I don't recognize it as a commodity. I'm going to take a look at the, is it dollar index? You know, I haven't traded that in a long time. Is it DXY? Let's check it out. Hold on. Let me look right here. Now let me. Oh, see, oil contract. Well, let me look for this. Looking at Japanese yen. Okay, I've got some before. So let's start with the Japanese yen because that's one that I trade often. I like the Japanese yen because it's a bite-sized kind of a contract, in that every penny move, so to speak, is this is a Japanese yen right here. Every penny move in the Japanese yen is $125. So a move from, let's say, 65,280 to 65,380 is $125. So I always enter the market with two positions. Okay. Now, if you know me probably from the mental and emotional part of trading, because that's really only shared how I've traded for all these years and how I've helped others to trade, and make trading plans, develop trading plans. I've written several books on trading plans. I've only done that really again for the last 4 or 5 years, but I was known as the mental and emotional guy for trading because nobody talks about that, and yet it's likely the most important. There's a lot of great trading plans out there, but not a lot of great. But what good are they if you can't run them? And that's why people go from trading plan to trading plan. So I like to take on two positions when I trade. Or if I take on 5 contracts, I treat it as 3 and 2. Or if I take on 6, 3 and 3, and so on. Because I always treat half of my effort with as a scalp, and the other half as what I call a runner. And the reason I do that is because I have that trigger that I described that 2/3 of the time gets me a nice advance early in the life of that candle, within the next 1 or 2 candles. Because I have that, I don't want to leave that low-hanging fruit without plucking some of it. I've never really been a scalper, but since I've focused my attention on helping traders with prop trading over the last couple of years. I've realized that that's an essential part of making that whole process work. For another discussion. So when I look at charts here, I'm looking at its ability to give me a fast movement, but also give me that long run. You see the dilemma, the mental dilemma that traders have is that they'll take a look at a chart, and and make their move. If it gets off to a nice start, you're always thinking, should I just take this initial movement, or should I let it go further? And that dilemma is a dilemma that if it isn't defined before you start trading, when and where to take a profit before you put on the position, you're going to have an issue. And that issue usually is you let the thing come back to break even, and you wish you had taken it. And then when you take it the next time and it goes and would have been a gigantic trade, you say, why did I get out so early? So by taking 2 positions, you can do both things. I hope you understand that, because if you leave with nothing today, especially if you're a prop trader, you need to consider that as an element as a major element in your trading plan. So let's take a look at this. I'm going to reduce this so I can see you a little bit better. Is this the right one? Yeah. Okay. Well, this is the 5-minute chart. Let's look at the daily. I hope this isn't. Yeah, it's one of my screwed up charts. You see this? Somebody one time can advise me on how to get rid of it. I haven't been able to do that. This is a mistick that happened several months ago. So I've been looking. I've been on another platform to look at this. But here's this is a continuation of what this Japanese yen chart has been doing. Now I don't have the if you have a chart that that goes back 10 or 15, 20 years, you can see how close we are as we descend to some all-time bottom. But you can't buy this market. this is not the kind of market. This is a daily chart, and it's not the kind of market. You can see that even though you can't see before this, it's really been exactly like this. The market challenges a high, comes back down. Now, I want to show you something that I think you could find valuable. This to me is a primary entry point on the short side for a number of reasons. And I'm going into detail here because I would expect, since we have, if you measure the distance from here to here, and then you measure the distance, from here to here, you're going to see it's pretty much the same. And if you have a market that keeps on loping like this, you likely get another lope in here. That's what I would be anticipating if I was dealing with the Japanese yen. But I wouldn't do anything. First of all, I would be looking for a place to go short, until further notice. In fact, the first time a market does this kind of thing, you can actually see each time it does it. I mean, this was a drastic low before this was a drastic low. So you're looking for a turnaround. Now, somebody could have taken a short, a shorter term view and traded this. There are some signals in here to go long, but I would be looking exclusively to the short side. Since I trade several markets, this would be on my watch list to wait for a rally, and I would check it on a daily or bi-daily basis. Right here, you need a few days it's going to take a week or two to kind of come up and start to look like what I wanted to do before I take a trade. If you anticipate a trade, as opposed to looking around for something that now exists, when you anticipate it, there's a sense of confidence when it happens your way, which helps you to do the right thing when the opportunity gets there. Again, a mental and emotional tip for you. So I like to, and there's so many things that you can do with trading, so many ways that you can make money. What I'm looking at here is the 8-bar exponential moving average. You're looking at the simplicity of my chart. And yeah, I do use an RSI from time to time, because what I want to see here is a divergence to help me anticipate a particular high, which I didn't get here. In any event, I like the 8-bar exponential moving average. Some use the 8, some use the 9. I like the 8; gives me slightly more room. And so, what is an exponential moving average? Well, a regular moving average in an 8-bar moving average or 8-candle moving average, you're taking the last 8 trades, the ranges of the last 8 bars, and you're adding it up and you're dividing it by 8, and you're coming up with a point that's the average of the previous 8 bars. When you have an EMA, the EMA, what the difference between an exponential moving average and is that they give more weight in that measure to the more recent bars, which is exactly what it is, but mostly to the most recent bar and a little bit less to the next. And the 8th bar back probably has the less influence. I haven't looked at the formula in a long time, but I know that it gives you more of a forward look or a current look, because you're giving more weight to the more recent candles in this. I say bars, but let's just call them candles or bars. All right. So when a market moves, I like to, look what's happening here. When it's moving in the direction that we want it to be, and when you look at a chart like this that's been going down, like this is 1/5 of a chart that's been doing exactly the same thing all the way down. And when I do this, you got to find places to short. Otherwise, you're just not going with the odds. And really, trading is all about the odds. When you get a break like this through the favored side, in this case, the short side, I like to ride this. You'll notice how it's riding on the south side of the 8-bar exponential moving average. Another thing that I want to stress is that I always wait for the close of a bar, of a candle. And I think that Steve Nissen and the late great, why is his name? Let's see, he passed away last year. What is his name? Maybe somebody can remind me.
Stephen Bigelow?
Oh, Stephen. Yeah, Stephen. The two of them would probably, and he's probably laughing at me right now. He had a good sense of humor. But they would both agree that waiting for the bar, the candle to close is really what you want to do. And I think those that invented the candle, the Japanese farmers, whatever it was 500 years ago, they waited for the close. In fact, they didn't give much attention to the wicks unless it was at the very top of a run or very bottom of the run, whether it was a shooting star or a hanging man. So there are very specific places where they choose to recognize the wicks, but in general, they had little or no credibility given to a wick. So when you're looking at, if I were in this trade, I'd be coming down and I'd be, I would be here thinking, well, maybe we have a reversal. I like to see at least 2 or 3 candles cross to the other side of the 8 for me to believe the move is over. So what you had here, so you're riding this right here. I'm giving you a little bit of background because I'm going to go faster through charts based on what I'm telling you right now. Okay, I'm giving you something that is basic truth in chart. I think people mess up them. They get messed up because they're jumping through too many hoops. In any event, here we go, and we have the first breach of the 8-bar exponential moving average here, where it's crossed to the north side. But I like to see that be continued a little bit, or emphasized, or confirmed. That's the word I'm looking for. Well, here's another another candle that is above the 8, but not very convincing if you're a trader. Now all of a sudden, it looks like we're getting back in the realm. Well, it didn't happen. Came up here. By this time right here, you may want to take a profit that came down in here. Okay, so I'm looking for, and you can see that there's often angst. There's often a fight at the 8-bar exponential moving average of the 9 that can signal you, it kind of announces the possibility of a turnaround. I also want to point out, boy, this is a really good chart to point out a few things. Here's another run. Somebody's going to ask me about somebody's going to ask me about, do I wait for a cross to get in? That's a matter. The answer is no, but it's a conditional no. And when I say that is, again, I'm a guy that likes to be in the market, but I like to be in it responsibly. I just don't get in it. I need the signal. I need the trigger. But if I'm taking it at a place where it's less likely, and I'll tell you why that's less likely in a second, I adjust my position sizing. I take the trade, but I take a much smaller position. This right here is a major take on the short side, and there's a number of reasons why. In other words, the fact that we haven't crossed here, if we're taking a signal here, and there isn't one here, but if your system calls for a signal, but the moving averages have not crossed, then I'm taking a minimum position on that. But right here is where, but this is the 34 EMA. There's a couple that I use, but I drew the 34 for you. It's a Fibonacci number, and the interesting part about it is I call it a guardrail. It's, sometimes you wonder how much room should I give a trade before I kind of call it a day, or how much, it's a responsible place to put in a stop, but give some breath. And if you use this, I won't describe what that means right now, but except for to say that the 34 is an area that I may mention along the way that I like to use it as once it gets up here, this close here would have, if I was still short, I definitely would have been out here. Now it didn't get, if you had patience and came down, but you don't know what's going to happen here. I like to have my trigger work for me, and if all of a sudden I believe the odds are 50-50, I'm out. I don't play the 50-50 game, and you shouldn't either. But take a look at what's happening here. You have the 8 or the 9, whatever you're using as the short-term moving average, and the 34 coming together. but then you see them separating. This is one of my triggers here to get in. In fact, it's a major trigger. And what I like about, and when it occurs at the separation of these two moving averages, like it is here, I mean, you couldn't get any prettier really than it's together here, and it starts to separate. This is a major signal. I mean, I can't go into the explanation mathematically of why it's true, but go with me on this. I think you're going to see if you start to backtest some of the things that I'm telling you, or you purchase our loaded gun simple trading plan, which incorporates all of these truths that I'm talking to you about. Look what happened here. I mean, you had, not only do you have the initial movement, I would have been in at the close of, I went to the close of this trigger, and then I sell here. Okay, so the market coming down here. You can see now. I would have taken my scalp right here. And what do I mean by that? You see this formation here that resulted in my take. If you measure that distance and project it down, I like to take my my scalp in that range. So right in this range, I would be taking my scalp. And then moving my stop to break even. When I can't describe really where you put your stop right now because it's a floating thing and it's easy, but yeah, I can't. I'm only giving you little pieces of what we use in the Disciplined Trader Mastery Program, and what I use in mostly every trading plan that I build for professional traders. So, so take your profit on the scalp, put bring your where you put your stop to break even on the remaining position. This way you go home with a winner. Again, if the market backs up, you can say to yourself, hey, worked out, I won in the trade, and I put a little money in the bank. But more than that, if you're a prop trader, then that uses a firm like Apex, what's going to happen is that when you leave that second position on and it comes back and breaks even, they hold that against you. The fact that you didn't take the profit when you had it. Well, you did on half your position. And therefore, when this is stopped out, you have a neutral result as far as the maximum drawdown that you can take. No, I'm talking now to prop traders. If you don't understand me, I'll stop there. But the idea is that for any trader, it's really a great idea to have a trigger that gets a nice pop when you start out. Take that pop. And I'm not talking about one or two ticks. I'm talking about a reasonable pop. You'll see that when I point to triggers, this is another trigger in here. You can see that you have a nice movement. Here's a nice movement here. And so how do you deal with your remaining position? Well, as long as it's hugging the bottom of this, as long as we're staying on the bottom of this moving average, you're in it. And if I had a long-term position on, and I was holding it overnight and so on, if I was trading a more conservative account, I'd still be short here because we have yet to breach this. Now, the other thing I must know, and I'd be expecting this on a daily basis, on a daily chart, because the further you move away from a moving average, whether it's the Fibonacci moving average or especially this one, kind of like it did here, the more likely you are to have a snapback to that moving average. So I'm expecting right here, right now, that we may get some sort of a movement here, but who knows? I don't. I can only anticipate and predict, but my predictions are usually, actually they're pretty good. But I don't trade based on that. Again, I would like you to start anticipating. So what do I think about this market? You gotta be a seller. So let's take a look at, if I decided on that before I start every trading day, I always go back to the daily charts and I get a feeling for where what I call the undertow of the market. Where is the undertow of the market? Okay, in other words, the daily has an influence on the 240 minute, and the 240 has an influence on the 60 minute, and the 60 has an influence on the 30 on the 15, etc. So if I'm trading on the 5, I've got a lot of influences on higher, higher bar, higher candle notations. But the daily is really the principal general flow of the market. So I call it an undertow. So when I've identified it, I say to myself, well, the long trades are going likely be limited and resisted, and the shorter trades are going to have more of a fluid personality, be more grease involved, because that's the undertow is helping me. It's, you know, if you live in Florida right now, you know what an undertow is. Um, and well, you also know to go with the flow when you're swimming. Okay, so in any event, that's what I'm looking. So let's look at the more recent chart. Let's look at the fives, because this is what I would be trading in this. So now here is, look at this. This is a, I hope you can see this. Yeah, you can see something happened while we were trading, while we were talking here, that that really gave a spike in the opposite of the flow direction. Okay, now if I were looking at this chart, and I am, I would take a look at these tops. I mean, there's a lot more going on before this, but I think the more immediate action, like what we're looking at right now, just like the flow, has more of an influence on what's going on right here. So what I do here is I would draw a horizontal line right in this area. Sorry, and I generally put it, you know, right at the top or somewhere near the action. I know that I like that, like the absolute right here, and then I may even put. I kind of like to put a. It's not letting me. Well, maybe it is now. Let's see. I put another one here. I like to have ranges when I, you know, this gives, I like to have a track to run on. Okay, so in this particular case, you're seeing, now this looks like a big move, but it really isn't, because a move from here to right up here is to $125. This market hasn't, this is 2 or 3 ticks, all of this. So it's not much going on here today. But I wanted to show you that I would probably have another line here. I know I would, you know, I like, again, I liked, again, support and resistance. It's nice to know that, because markets tend to check these supports and resistances. I will, let me comment on what I'm seeing right here. And well, right here is what maintained this line, was what resulted in this line for me that I'm drawing. And when the market came up here to this line, you can notice the fight that it has on a previous high, especially the most recent previous high. Why? Because people are looking for lower highs and lower lows like you're having here. And it takes a little bit of courage and momentum to break through that high. So you can, here's another example of the failure. Here's a failure of the high. You have the high here, you have the test of the high here, and a failure. And most of the time, not most, I'm going to say most of the time, and it's untested. You'll have tested fees. They're just by my recent memory of the currencies and so on. Most of the time, you'll see the failure. So the thing about supports and resistances is that you want to honor the fact that you're going to have a fight and a likely retrace in a long trade like this, in a long movement like this. Where is it going to go? So here's where, if you had 6 positions on 6 contracts of the Japanese yen, maybe you took out 3. This is actually a buy signal in here. I would have been taking out 1 here, and then I would have taken out, or 2 out of my 6, and then I would have taken out another 2 out of 6 right here at the test of the high, and leave the other 2 of my 6 for what I call lewd and lascivious. It's not likely to happen, but if it does happen, I want to be there. Because the other thing I want to say about, and this is why supports and resistances are not honored the way they should, but you should, with the majority of what you're doing. But I always leave a little bit, if I can, for the break of that. Because when a market breaks a resistance or support level, that's sometimes where you get a big move, just like right here. Okay, you didn't get it here because the majority of the time you'll get a retrace and maybe a third top. But here, you know, we had a mess. And that then and it's still a mess. You can see that we're not really honoring much as far as the golden moving average is concerned. But here is another test of this high happening right here. And In fact, this actually right here is a signal for us. Now, what I take this signal, and again, you're seeing the separation of the two moving averages actually like this. The problem with this is that if I took this, I would see a problem right here. Here's where, in this particular case, and you got to look at your environment, here's where I would be taking my scalp. If I took 5 contracts here, I would be taking 3 out here. I always favor toward the scalp. Okay, so in this particular case, I would be taking 3 and leaving 2, moving my stop to break even, and I would have gotten my scalp here. And I'm not sure whether I've been stopped out or not here, but that's not the point of this discussion. But look what happens when. But look at the the doubtful the doubt that the market is giving us, whether it really wants to take out this high and test these former highs, since we seem to be getting lower highs and lower lows. Really, it takes a lot to reverse even a short term like this, short term flow. But look at where we are as far as the 8. We still have all our candles over the 8, and when you get to when you hug it totally, like this candle is hugging the 8, here's where sometimes you get your pop a lot of the times, and you got it here. So now we're taking off, and the first test was in here. Now, of course, this looks like it's some sort of a break, but it's a break of the time from one 5-minute increment to another. This probably just went straight up and blew through all of this. So you look with that. What happens? I'm sorry. I need to. Let's see if I can just say goodbye to this. Close my window. Let's quit Skype here. I didn't mean to interrupt you. So I would be looking for a retracement here. I would be looking for, and you're starting to get a little bit of it here. So, I don't want to predict something that's already happened. I tell you. But again, from my previous, I'm looking for, long positions to be muted, or short term, looking for longer positions, shorter positions to have more leg on it. Okay, so that's now. There's one other thing I wanted to show you that I think is important. I'm going to go back to the day chart because I saw it on the day chart but didn't see it here. Somebody's got to tell me how to get rid of that. Okay, here it is right here. Right, it's right here. When you have a movement like this, you see how we're coming down nicely, and we're we've moved away from the 8-bar exponential moving average here, and instead of a snapback, the market is going sideways. This is what I want you to recognize. When a market, there's 2 things I want to say. The first is that when a market goes sideways like this, it's important to be ready to have the next leg down in the predetermined direction, which in the short and long term here is down, and the very long term. So we're looking here at the 8. This is count, and look at how it's staying away, but still on the south side, and then breaks to the south side. This is very common when you see a distance from the moving average. It can either jump back or go sideways. Now, an inexperienced trader would take a look at this and say, wow, it looks like it's consolidating, looks like it may turn around. I don't say that to myself. So what I say as an experienced trader is, wow, look at this, looks like it's ready for another leg down, and so that's really what you should be anticipating here. And in fact, this kind of movement could have gotten a lot of new traders long. In any event, what I do is I draw a simple line, because generally I'm running a business while I'm doing this. And I don't suggest that you do that as a trader. You really want to stay focused. But I take a look here, and I would draw a line, in here to represent the bottoms of this. Okay, if we break that bottom, like right here, I would be short. So this is what would trigger my short position. And then you ask yourself, how far can this move go? I'm short now. I mean, is it going? There's a number of ways of doing it. You can see, you can kind of look back and see the general. Generally markets have a repeating characteristic to them. But I'm going to give you something that that was taught to me 40 years ago, and I'm going to give it to you. I still use this. You can't actually use it on your monitor because you'll break your monitor. But what you want to do is, I don't know if you can still see me, but let me see if I have it here. I always have it at my ready. Of course I have it. This right here, if you can see me, if my thing is still on, let me see. Just looking right here. Yeah, it's still on. This right here, for those that are not engineers that studied in the 1970s and 80s, this is a compass. Okay, it's got a pencil on one end and a pin on the other. And what I do, I'm going to disappear here. I just want to show you the compass. What you do is you put the pin in one area and then you draw a circle around it. That's the way we used to use it. But I want to show you another way to use it. Let me just get out of my own way here by doing this. Okay, what I do is, so how as far as I'm concerned, the length of this accumulation will help me dictate the extent of the move. I put my pin here, right here. I put my pencil here. Now I'm not actually touching the screen when I do it, but I do it. I lean up and I told you I was old school. I put the pin here, I put the pencil here, and then I rotate it. And you can see that this length here, when transposed here, this horizontal, this is about it for this, most likely. And here is another place that I may peel if I had multiple positions on. So that little measure, you're going to find it very, very handy. Look at here. And it doesn't have to be even against the moving average. Look at this accumulation. Take this length, project it up. You can see where it stopped. Very, very accurate. And so if you only take two things from this talk, take the fact that you should be taking on multiple positions, and the fact that this is a great way when you get an accumulation like this to measure where you predict the going. Okay, so that's about it. That's all I'm going to say about the Japanese yen, except for, let me just look at one thing. Again, that's how I would be trading the Japanese yen. There's really nothing to talk about here from the standpoint of this, because and you can see we're starting to ease. I've got a lot of people excited. I would be looking for a movement lower here through the 8 on a closing basis. Even 34 would be even better. If not, then I would have a light position, stronger position on both. So I would be looking to short this at all times until further notice. One thing, now I trade the euro dollar also, and the reason I trade the euro dollar, and I trade the Japanese yen. I will say something that will probably hurt you more than help you, but look at it yourself. In general, the euro dollar will mimic or move in a similar way to the S&P. Here's the S&P, so it's not true today, but many times it will. So watch for that on another indicator basis. Not that you should really never look at one market, have it break, and then short the other market because you think they're related, like gold and silver. Don't do that. But I will say that the main reason I trade the euro dollar is when I'm expecting lesser moves against the dollar. It's all against the dollar. Euro dollar against the dollar. Japanese yen against the dollar. The Japanese yen, because it has a 66-cent basis, and the euro dollar has almost $1.12 would be the double or whatever, $1.13, $1.07. It's almost twice the impact on a percentage basis as the Japanese yen. So when I think the market will be slower, I tend to look at the euro dollar because I want more action, and since a smaller move will mean more money, a smaller percent, the same percentage move will mean more money for me in the euro dollar than the Japanese yen. I trade the euro dollar when the market is more active, much more active in the Japanese yen. The Japanese yen will, more often than the euro dollar, will be alike with the S&P. The Japanese yen will many times be opposite unless it's a very strong interest rate moves. Look what's happening today. We're seeing kind of a upswing in the Japanese yen, downswing in the S&P. So I trade both of them for various reasons. The gold and silver, I really think everybody out there should be considering gold and silver between now and the end of the year. Why? Because gold and silver, silver especially, tends to move after gold. And we've seen a major move in gold. It's over 80-to-1 gold, the silver gold ratio, the gold silver ratio, over 80 times the price of gold, of silver. That should be more like 50 or 55-to-1. So those who play spreads are selling gold and buying silver in equal amounts, which I think is a great trade right now. But in general, I'm looking at ways to get long in the silver market, which is here. All right, let me see if I've kind of beat a dead horse with the. Shouldn't use that expression. I give, those are the charities I give to, the horse and saving and the, let's see, Japanese yen. I got that going. All right, delete the bar. Delete the bar creating that problem. I don't know how to delete that bar. I've been looking and looking. I'll look for a way to do that. But thanks for giving me directions here. Which asset chat are we talking about? I can't see clearly. I don't know what an asset chat is, but we can. You need some more coffee. Yeah, I do. Oh, am I talking too fast, Dennis? I don't know. It's the Japanese yen currency futures. All right, we've got the euro. Okay. Well, let's look at the S&P. Unless you want to give me a, is there any print money for us to trade? As they print money for the U.S. Treasury goes up, yes, I mean, as they print money, it's true of any M1 or any M2 measure. The more money represents the same goods and services. We're not on any gold standard, so our dollar represents our ability to produce goods and services. When they produce more paper, when they print more money to cover things, whether it be COVID or Israel or whatever, they print money to send and we don't have it. That's more dollars representing the same production of goods and services, and therefore a dilution of the strength of the dollar, and therefore all currencies, including the euro dollar, will go up. I think we all know that. Okay, here's the daily chart of the S&P. Again, let me see if I can. I'm sorry that I have to do it, but here's a this has been a pretty steady. Again, look at how in most of the trading plans that I write, they're asking me, well, how do you know when, how do you know this wasn't a reversal, or this wasn't a reversal, or this wasn't a reversal, or anytime we cross over the 8 in a powerful way under the 8. I like to see at least 2 closes below the, if I'm long, I like to see at least 2 closes below the 8. Here we didn't get it. Here we didn't get 2 closes below. Here we got 2 closes below. Now, when I see this and I want to stay in, and we haven't breached, I think this is still the 34, yeah. We haven't breached a Fibonacci number here like this, EMA. What I like to do is to stay in if I can. I mean, this candle right here, this spinner, is really a neutral. I mean, it's a hesitation. A new trader, an inexperienced trader, will say this is a reversal signal. Now, I don't know if it's a reversal from this candle or a reversal from this whole trend, but it's not a reversal. It's a nothing. It's a hesitation because the market is unsure where it wants to go in this 5-minute period of time. It was pretty sure it wanted to go down, but all of a sudden it wasn't so sure. So what I like to do is I like to, again, take my, what I do is, I don't even need this. What I do is I look at whichever is the low of these 2 breaches of the shorter term moving average, whatever is the low, I put my stop under there. And if it takes out that stop, then you've got another reason to believe this move may continue. So I would have stayed in here because we don't have 2 candles. We don't have 2 candles closing below the 8, or I think this is the 8. And then we have the same thing here. But here we had 2 candles close below. but I used my, what I call a nuance, which is something that it's another discussion, but I include what I call nuances in my trading plans, especially we have a couple of great ones in the Disciplined Trader or in the Loaded Gun Simple Trading Plan. And the reason I have nuances is that it may be good for some and not for others, but it's a valid movement if you want it. This is for a more aggressive trader that's not willing to take that additional risk that is willing to take that additional risk if they get stopped out. So I'm that trader. But if you're not, if you want to grab the profit here, there's nothing wrong with that. There's never a wrong time to grab a profit. And I really mean that, because if you've got a good trigger, you can be doing that all day. But if you're like me and also like the idea of having a nice big move, like I had on Monday, then you want to keep some of the gunpowder in there. So look, two not close below, only one close below, and then a reversal back. Two closes below, I used my nuance, stayed in the trade. One close below, nope. One close below, nope. So even though this looks like a mess, I have a rule. Okay, you need rules. So that's my rule. And I didn't even have an issue with any. I'm in all the way up here. But look what happened here. One close below, two closes below. Okay, I'm always looking around too. I'm seeing an arch now in this in the moving average. Okay, I'm short. I'm going short here. I'm taking my profit here. Why? Because I have a rule that says if I have two closes below, I either get out or I put in my nuance on here, and I'm getting short in here. Okay. Now, you would have sweated if you got short here, but it was a pretty free, never took out this high, which is probably where your stop should be. I won't go into the proper places to put stops, but you always need to stop. You always need that second chance. Even if you get three losers in a row, that fourth chance can make you whole. Okay, so always have enough to keep you whole. So you would have been in on this. You would have been in on this with the very basic of rules that I'm talking about. So so here the S&P. This is of course the daily. I would be looking, from a nuance standpoint. We've got a crossing of the moving averages. I'd be continuing to look on the short side. I would have from here on in. And I mean, it's easy to say when this is all here. These lines are for short-term stuff that I was using when I was trading in here, when this took off, I think, and I was looking to go long and wanted some stops. In any event, but that was for more of a retirement account. This is for a day trading account. This is, again, I'm using this as an undertow. I'm saying to myself, I'm going to be favoring the short side here. And that's really where I made my money today. It was right here is where I shorted right in here. Why? I had two closes below, okay? And I had my stop up here. And I got nervous here. I don't get nervous, but I was laughing at myself. I'm going to talk about this, I'm going to say, and it's not going to turn out. Well, it did turn out. I took some of my profit here. Why? Because this is a support level. Support here, support here. Yes, it broke, but it usually doesn't. But if it's going to, it's probably going to be in the direction of the undertow. But I'm not going to count on that. I'm going to take a profit here. In this particular case, I only had two positions. So I just took my first one in here. And the market went down. And I had I actually got out here. And I got out here because I knew I had this going on. And I also have guests at the house. And this looks like a place where it could turn around. And as far as I'm concerned, if you got to be pulled away from the screen, you just get out, take your profit, go on. But if it wasn't for David and having him invite me to this, I would have been in this trade. So it kind of owes me a little bit. But look at how it's hugging this. Look at how it's hugging. Can you use the methodology on VXS? You can use this on anything. I use it on any stock. I use it on any, I use it when I'm coaching Forex traders, when I'm coaching option traders. Option traders love what I do because they know when to get in and get out. And again, I'm very open. I'm only giving you enough here to hurt yourself probably. But I will say that it's not a big investment to own the Loaded Gun Simple Trading Plan, which introduces you to all this basic stuff presented in a modern way. And if you go to theirmoneyyourprofit.com, theirmoneyyourprofit.com, you will see my offer for the loaded gun simple trading plan, and I think it certainly is a fair price. You'll see, myriads of testimonials. Even before I altered it a little bit, I massaged it a little bit to fit into prop trading. If you're a prop trader, you have to own the loaded gun simple trading plan. Okay, but look what happened here. Look how it hugs. One close above, no. One close above, no. And not even close. This market is, this has, just continue on the short side, until further notice. Okay. Now, when you get this low, people say, do you use a trailing stop? I haven't looked at it, but I generally use 2 bars below, 2 bars before. And I think this would have kept me in. So if this was the live bar, this green bar, my stop is up here. Okay. And I'm looking here. So here I would put my stop here. So, and then these two, when this bar was alive, my stop would be here. I'd be in for all, even this one wouldn't knock me out. I would have been ins using the high of 2 bars, above the high of 2 bars before. Here it looked like it took out the previous bar, but not 2 bars. So I don't use the previous bar, I use the two bars before. And you would have been in this move all the way down, right from the trough, using that protective mechanism. Okay. So I'm giving you a lot of stuff here, and maybe I'm not telling you what, I'm telling you what to do from here in a general basis, but I guess I'm telling you, stay on the short side of this market. Otherwise, you got to be on your mind. Okay. So that is, that's what, now, let me think here. If you want, yes, I'm going to put here, use this coupon code. I think it's still good. If not, write me. This is going to give you half off prop sale. If you go to theirmoneyyourprofit.com and use the coupon code prop sale, you're going to get half off. Okay, and that is a very that's a very short-term thing. I thought it was just looked, it's still alive. So for you today, you can use this if you want. Okay, prop sale, half off on this. Okay, so we only have a couple of minutes left. Let's look at one more if you've got a suggestion for me. Anybody have a suggestion? Take one more quick one. Come on, somebody give me a futures contract to take a look at, and we will go from there. I'll just give you my first. Can you put the code in the chat? Host, I said host and panelist. Would you put it in the chat, David, for me? Prop sale. Yeah, there it is. Prop sale. Thank you to everyone. Hey, appreciate it. Stolichnaya. I think I'm a friend of yours already. Okay, I got a special. If you buy Stolichnaya, I got a special gift for you for that. I give you some of our bling here, some of our disciplined trader bling. Hey, Jeff, great. Thank you. I will. Great. Anyway, I really wanted to show you what I'm all about. I have an uncomplicated life. That's what you want as a trader. You want to be uncomplicated. I can't help but show you probably the speaker after me, although Michael is pretty open-minded. His charts are going to be a little bit more complicated, but he's a good trader and great trader. But I want to show you this. He's going to take, I don't know if he's going to love this or not. Don't know if he's still here, but this is the Bitcoin, and it's very tradable now. But look at some of the rules that we've been talking about. This, you see how the moving averages are together here and how it starts to expand. This is one of our signals also on the short side. But look here, you got one breach, okay, of the 8. A second breach of the 8. I mean, it did close above the 8 by a hair. So I put my stop above that, just if it's going to continue, and it doesn't. You would have been in this trade the whole way down. And this is 62.5. Is this a daily? No, this is a 5-minute chart. So 62.5 to 6. This is almost a $2,000 move in Bitcoin, and you would have had it, 1,500 of it. Even here, you wouldn't have been shaken out because you would have had your stop up here. You would have been still in this trade. So the Bitcoin, now you got a double bottom here, so be a little careful. But the Bitcoin is a tradable commodity. I'll report. In fact, I'll report to Michael after this, the guy after me, and let him know how I'm doing with this. But I've had some really nice trades in the Bitcoin. But you got to discuss with me a little bit about where to put your stop in, or if you should put in one. You got to be on top of it because there's a gigantic spread still, not as bad as it was, but something almost within reason. So I want to show you what you need to do that to keep yourself safe there, but still be able to trade that. Okay, everybody, thank you very much. I hope you join me at Loaded Gun. We have a kind of a community. We meet every Wednesday. In fact, a week from today, the last Wednesday of the month, we all meet and talk about our experiences and all the qualifying we've done in our prop trading, so on and so forth. So anyway, I'm going to leave it to you and let Michael warm up. It's 55 after the hour, and thank you everybody for being here.